If you want to make an expensive purchase, should you take a credit card EMI or a personal loan? This question is often in the minds of many people. Both loans have their own pros and cons and both operate differently. If you need funds for a big purchase, a personal loan could be the right option. It allows you to repay the loan in a structured manner. On the other hand, to take advantage of routine shopping and promotional offers, a credit card with EMI option could be more beneficial. We can compare these two based on different parameters. First, let's talk about the borrowing limit. In a personal loan, the borrowing limit usually depends on your income and your credit score. This means compared to a credit card, you can get a bigger amount with a personal loan. Conversely, with a credit card loan, you are limited or restricted to the credit limit available on your card. Now let's talk about disbursement. How do you get the loan? In a personal loan, after loan is approved, a lump sum amount is credited to your bank account. This can take a few days. In contrast, a credit card loan is immediately available. You can get funds up to your available credit limit instantly. You can repay this loan by making purchases and converting them into EMIs or equal monthly installments. Speaking of documentation, when applying for a personal loan, you need to provide many essential documents like income proof, employment verification, and identity proof. Whereas when it comes to credit card loans, no additional documents are required. This is because you have already provided most of the necessary documents when you were taking the card. Now let's talk about the interest rate. The interest rate on a personal loan is usually fixed, and it is determined based on your credit score and the terms and conditions of the loan. This rate can be lower than credit card loans, which usually have varying interest rates. There can also be different rates for EMI conversion on credit card loans. Another important parameter is borrowing type. A personal loan is an installment loan where you have to repay a fixed amount with interest within a set time frame. On the other hand, a credit card loan is a revolving line of credit. This means you can borrow up to your credit limit, repay the amount, and then borrow again. Let's look at the pros and cons of both of these loans. In a personal loan, you can get a large amount. The interest rate can range from 10.5% to 24%, and the loan tenure can be anywhere between 1 year to 5 years. On the other hand, interest rate on credit card EMIs starts from 12.5%, and it can vary based on the bank. Repaying a personal loan on time can improve your credit score as well. The disadvantage of a personal loan is that interest rates can be higher for people who have low credit scores. If the credit history is not good or the credit score is not good, then getting a loan can be very difficult. If you want to repay the loan early, you may have to pay an early repayment fee or pre-closure fee. Counting on the benefits of credit card EMI, you can get an instant loan. There is almost no paperwork required. This loan can be beneficial in case of cash flow issues in the short run. High-value transactions can be converted into EMIs. Repayment can be done within 3 to 24 months. Talking about the disadvantages, credit card loans can be more expensive in the long run. And especially if you have not paid the balance on time, these loans can cost you a fortune. Since these loans are directly linked to your credit card's available limit, it may also reduce your ability to make purchases for other needs. Also, the credit utilization ratio, which means CUR, can increase, and all of this will affect your credit score adversely. Moreover, due to easy availability of credit, you might find yourself indulging in unnecessary expenses, which can increase the burden of debt on you. Whether a personal loan or a credit card EMI is better for you depends on your financial situation and financial goals. While a credit card loan or instant loan is suitable for immediate or short-term needs, personal loans are far better for long-term requirements. However, when you're taking a loan, don't just think about your immediate needs. Also consider its impact on your financial situation in the long run. Consider factors like how it will affect your credit score. Also consider its impact on your financial situation in the long run, like how will it impact your credit score. It is important to think about this, and only after considering all these factors, decide which loan will be right for you.